equity outlook, where do we see markets in next 1.5 years, which are the sectors which we believe can create value for, you can say, investors. And post that, I'll touch upon our new NFO, which is consumption. Why consumption now, and how LIC's consumption fund will try to be differentiate from its peers, and what kind of expectation that investors can have from this fund. So basically, starting with market outlook, we all know at any point in time, we have n number of reasons to sell the market and wait for better entry points. So I have been in the market for 20 years, and I think the way I'm seeing is you have been, many of you have been in 35 years also in terms of the market experience. So every day we have n number of reasons to sell and only one reason to buy, which is a kind of, you can say, faith that earnings will keep on growing and companies will keep on growing. So currently the kind of noise that we are seeing, tariff war, armed conflicts across the region, global capital flows. So always we have some exciting times. Earlier there was DeepSeek scare, yen carry trade unwound, Russia-Ukraine war, Fed policy, global recession. So if you see the long-term charts of any market, so markets don't go one way up, so they have been volatile. So volatility in between the long-term range is basically this noise. So any event which is happening across the globe or across the country, so we have to see it from the lens of whether that event has the potential to change two things, because market eventually is a function of two variables. One is earnings, second is P multiple. So if any event is impacting the earnings profile over a long-term period, or maybe P multiple of the market over a long-term period, then we have to take cognizance of that event. Otherwise, we have to ignore that event as a market noise. So I'll just touch upon where do we see the market from the lens of these two variables only. Earning growth, as we all know, is a factor of nominal GDP growth of any country, unless we are investing into some export-oriented companies which may be a part of the global economy, but more or less 70-80% of the index is basically dependent on the domestic nominal GDP growth. And then we try to find what are the factors which can push that sector's or that company's growth to above the nominal GDP growth, and what kind of multiple we should pay, right? So this is the key thing to look out. So as of now, we all know domestic economy is growing maybe in 6.5 to 7% in real terms, 9-10% in nominal terms. So we'll reach $7 trillion sometime in future. But the components of GDP keep on changing. So it's not that every sector is growing at the same pace. So the value creation happens in those sectors, in those stocks which are growing better than the nominal GDP growth, because eventually the market or investors chase growth. To break it down further for the investors, we have to see which component of GDP is driving the growth. So as of now, if you break down the GDP, 57% of the GDP is consumption oriented, 36% is capex oriented, and rest is export and revenue expenditure. So two large segments of the GDP are consumption and investment. I think these are the two factors which we should keep in mind while taking a call on the markets. So as of now, we know last 5 years, GDP has been purely driven by the investment, because consumption as a whole has been lagging the nominal GDP growth or real GDP growth, and the kind of stock returns you have seen in the capex related theme, manufacturing related theme, I think that is reflective of the driver of the GDP. If you go pre-COVID, consumption was driving the GDP growth rate, investments were growing only in low single digit. So we saw large value creation happening in most of the consumption stock, Asian Paints of the world, HULs of the world. So I think that was the thing. So we have to see from here what will drive the GDP going forward, and what kind of growth opportunities are there overall. So first of all, GDP though will reach $7 trillion, but composition of GDP is changing. So investment and exports combined are going to be 50% of the GDP, close to 50% of the GDP in next 5 years. So I think this is the area to focus, investment and export. At the same time, consumptions, though percentage is going down, but on aggregate level, consumption as a percentage of GDP is growing in 10 to 11% CAGR. I'll come to this breakup of this consumption when I discuss about our NFO, which is the consumption. But this is the kind of investment which are happening, because there have been some concern that government is not spending enough on infrastructure, so that means the infra story is over or capex story is over. But the current theme is much beyond the government spending, because the kind of investments that we'll see in power sector, renewables, transmission and distribution, data centers, manufacturing, I think combined is $124 trillion is the kind of investments that we are seeing. So this we have done from the grounds up. It's not some agency's estimate. So we have done project-wise analysis what kind of investment that we'll need. So what we are expecting is 124 trillion rupees of investments happening in next 5-6 years. And that means investment as a part of GDP will grow in high teens. So I think that there is opportunity for the investors. Second thing, what we are seeing is corporate capex quality is now rising. Earlier corporates were just investing whatever the depreciation rate was there overall. But now if you see the trend in NSE 500 companies, corporates capex to depreciation ratio is rising. So that means corporates are now looking to invest more than the maintenance capex. That means they are looking to invest in growth. So the capex, I think, theme is now there. Second theme, which is the largest segment of the GDP, which is the consumption. I think there have been 5 factors. So I think which one needs to consider. If consumption will come back very, very strongly, I think in the next 2 to 3 years. First of all, everything is cyclical. So if you recall, we saw large uptick in the consumption after COVID when the lockdown was opened. So people bought many things, kitchen appliances, wardrobes, maybe many went for travels and all, fearing that another lockdown can come in. So before that, we can buy whatever we wanted. But after that, when the things normalized, there was a lull of 3 to 4 years, because maybe people bought much more than what they needed. So there was a lull in terms of the overall buying pattern. And that reflected in the, you can say, slowdown, or you can say slowdown in the consumption. But now everything has a replacement cycle, 2, 3, 4 years, 5 years. So consumption revival has to come as the things move to, you can say, people move to refresh their wardrobes, or maybe change their appliances, or maybe premiumize their existing appliances. So I think that is bound to come. So that is cyclical factor. But the external factors which has changed for the consumption sector is, one is government's focus on driving the consumption, because till now government was focusing on investment, doing the capex to pull up the GDP. Now government has limited resources. Now they are saying that now consumers need to also spend for the economy to grow. And for that, to address the issue of affordability, they have gone out with GST rate cuts. But at the same time, to enhance the disposable income, they had gone for direct tax cuts. So I think these two, on one hand, they have increased the affordability, and on second hand, they have given more money into the hands of the consumer. So I think these two factors alone have some potential to revive the consumption, in addition to normal cycle, which we expect to turn around. At the same time, the initiatives by the RBI to cut interest rates aggressively, to cut CRR aggressively to give more liquidity, and at the same time encouraging banks and NBFCs to give consumer loans, because till last year RBI was discouraging, fearing that the consumers are over leveraged, they may be bubble in the MFI space and other unsecured credit. But now there has been marked change in the stance. So all these 4 or 5 factors have the potential to catalyze consumption, I think, in the next 4 to 5 years. So largest segment of the GDP starts firing, I think that will reflect into the investment also, because as the consumption rises, corporates will move to invest more, and this has the potential to accelerate the GDP growth. And that will reflect into the earnings also. As of now, we are expecting 12% kind of earnings growth. So there have been concerns that market valuations are high. But if you see in the context of interest rates, so average P multiple for the last 10 years have been 20 to 21 times P multiple for the index. Currently, we are at 22 times. But if we see the interest rates, in the last 5-6 years, interest rates, 10-year GSEC have gone down from 8% to 6.5% currently. So if the bond yields are coming down, so that means currently bond valuations are 15 to 16 times P multiple. So equity at 20-21 times seems reasonable. At the same time, the quality of earnings, if you see the ROE of Nifty 50 companies, it is now at 16% approximately, which was down to 12% in the previous down cycle of 13-14. So on one hand, we are seeing return on capital is rising and cost of capital is going down. So whenever the difference rises, return on capital versus cost of capital, that should reflect into the higher P multiples. So currently, P multiples at 22 times, I think we are at fairly sustainable levels. But the kind of earning growth that we are seeing for the next 2 years, and that is very, very broad-based, banking, financials, healthcare, commodities, auto sector, capital goods, across the sectors are growing. So that makes us hopeful that there can be double-digit kind of equity returns possible on a 2-year CAGR basis from here. So now I'll come to funds. So just to introduce myself, I have been managing 2 flagship schemes of LIC mutual fund. One is multi-cap fund. Second is dividend yield fund. And apart from that, I have been managing larger mid-cap and mid-cap fund as a co-fund manager. And recently, I have been given the responsibility to manage small cap also. And most of these schemes we have been managing based on the growth philosophy. We try to find the companies which have been growing faster than the general market and try to capture that growth in terms of the returns to the investors. So now coming to a consumption fund. So first of all, just to give you some background, in most of our schemes in the last 3 to 4 months, we have gone overweight on consumption. And we thought that this is the right time to launch a fund which is dedicated only to the consumption. And why consumption now? First of all, as I showed this chart earlier, consumption as a basket is growing at 10% CAGR. But within that basket, if you see, the pattern is changing. Roti, kapda, makan, food, beverages, and all these things which are essential, their contribution in overall spend has been going down. So their contribution has gone down from 50% to 30%. But the discretionary consumption, which used to be in mid-single digit or to double digit, low double digits, is close to 45%. So that means even though consumption as a whole is growing at 10% only, but this segment, which is discretionary consumption, which is growing at 15 to 20% CAGR. And I think there lies the opportunity for the investors to make money. So some examples here. So if you see in FY12 to FY25, SUV's proportion as a percentage of overall car sales have become 5x in last 10 years. So SUV as a portfolio, for example, for Mahindra & Mahindra has been growing at 25% CAGR. And at the same time, entry-level cars of Maruti have been degrowing. That shows people are willing to pay premium for the, you can say, value addition or brand perception. Secondly, share of entry-level bikes. Why Hero MotoCorp has underperformed Eicher Motors? Because Hero MotoCorp segment, which is entry-level bikes, their contribution has gone down from 50% to less than 30%. So incrementally, whatever growth, incremental growth has been captured by premium high CC motorcycles. Similarly, AC versus air coolers. In last 10 years, we have seen 3.5x growth in air conditioners versus 1.5x growth in air coolers. Room rates, 5 stars, room rates have been going in double digit, but you can say low-end room rates have been going in low single digits. So that means there is more demand for the 5-star and 3-star and 4-star room rates. In terms of Alcobev sector, if you see, I'll just give you an example. The likes of Radico Khaitan or more recent listing Allied Blenders, the kind of run-up they have seen, only because incremental brands, what they have launched, they are fetching 10x their company level realizations. If the company level, they are realizing 500 rupees per case kind of realization, incremental launches are getting them 5,000 to 10,000 rupees per realization. So even 1% delta is leading to large expansion in the top line as well as bottom line. So the kind of wealth creation we have seen in Alcobev space. Same thing we have seen in luxury watches. Titan's luxury, you can say, watches segment has been struggling, but at the same time, Ethos, which is a luxury watch, has become 4x in last 3 years in terms of overall profitability. Same thing we are seeing in footwear. Bata, Relaxo have been struggling to grow. Metro brands have been growing in double digits to 15-16% CAGR. So that shows that even though consumption has been subdued, but the pockets within that consumption, which is premiumization, discretionary spend, has been growing in mid to high teens. And I think there lies the opportunity for investors to make money. What is driving these changes? I'll just show one data point. At this point in time, 45 to 50% of the overall consumption is being done by the Gen Z clients. Gen Z means those born between 97 to 2012. So basically aged between 13 to 28 years. So, and proportion of this population in overall is around 25%. So 25% of the population is driving 45 to 50% of the discretionary consumption. And within that 25%, only 1 in 4 are working as of now, because many have not achieved the working age as of now. So as these Gen Z people from 1 in 4 goes to 2 in 4 to 3 in 4, you can imagine what kind of consumption they will do. I think that is the key thing to watch out for. Millennials anyways have been growing at their own pace, but Gen Z and Gen Alpha I think is the key thing to watch out for. And where they are spending fashion and lifestyle, beauty and personal care, travel and tourism, then you can say consumer tech, data, eating out, packaged food. I think these are sectors which are the potential wealth creators for investors. Second most important factor we have to see is rising female participation in the overall workforce. So now 40% of the workforce is female. So as the females start to work, you get double income in a household, and incrementally whatever incremental income that comes, so that goes for saving or consumption. And so that is another factor. And one thing I want to highlight more is the rising income and wealth effect. So if you see the CAGR in terms of tax filers, so the guys who have been earning more than 1 CR have been growing at 14% CAGR. Between 25 lakh to 1 CR, they have been growing at 13% CAGR, and 10 to 25 lakh is again 12-13% CAGR. So this is the growth in that, you can say people earning anywhere between 10 lakh to 1 CR. If the number of people are growing at 13% CAGR and 1 rupee extra they earn, so that goes into the discretionary consumption. So that means if the consumption pattern is being driven by this segment, so if the base itself is growing at 13% CAGR, so there is no doubt that incremental consumption will be in mid to high teens overall going forward. One more data point I want to highlight is basically a number of households which have been earning more than I think 30 lakhs. Those are becoming 15x in next 10 years. So people who have been earning 10 lakh, 30 lakh on an overall basis, including everyone working at home, there is a growth of 10x in next 10 years. So I think incrementally the kind of consumption opportunities we'll see in that sector is immense. Now, changing consumer behavior that we all know. But why consumption now? This slide I explained it earlier also. So there is a term called Lollapalooza effect. So when 4 or 5 factors work in tandem in any industry, so the extent of outcome which one normal human mind can, you can say, estimate is very, very different from the actual outcome. Because when 5 factors, they work in tandem, it's not addition, it's multiplication. So I think consumption sector has that potential as of now. The 5 factor which I mentioned, reduction in income tax rates, reduction in indirect taxes, GST, CRR cuts, you can say reduction in EMIs by lower interest rates, as well as the RBI's intention of propping the GDP by giving stimulus to the consumption. I think all these factors make us very, very bullish that when these 4 or 5 factors are working in tandem, so the outcome can be in multiples, not in addition. So now LIC's consumption fund, how we are trying to add value or to create wealth for the investors. First of all, this will be a bottom-up fund. So if you see most of our sectoral schemes, whether infrastructure, manufacturing, healthcare, BFSI, if you compare the portfolio construction to the benchmark, we have been very, very different. So we try to capture the, you can say, incremental addition to the GDP, the sectors or companies which are driving the GDP growth, rather than sticking to the benchmark. So it will be a bottom-up approach. At the same time, top-down approach will be driven by the longer-term, you can say, trends. For example, one is urban uplift is the strategy for this fund. Urbanization, premiumization, then you can lifestyle changes, income, rising income, formalization and technology. So this will be the strategy. Urbanization, we all know incrementally India is becoming more and more urban. We used to be 17% urban country in 1950. Currently we are at around 30%. and that will go to 36-37%. So as the more urbanization happens, the spending on healthcare, spending on travel, entertainment, all these things, they inch up exponentially. And anyways, urban people are spending 50% more than the rural people on these discretionary items. So as the more urbanization happens, I think there is bound to be more spending on consumption. Premiumization, as I already explained, the kind of growth we are seeing in branded footwear, branded retail, SUVs, you can say more than 1 CR value of houses, I think that is growing exponentially. Why affordable housing has not picked up in India, but the likes of Prestige, DLF, they have been growing in 15-20% CAGR. That means people have more aspirations rather than only buying affordable houses. So I think that is reflecting in the premiumization trend. Then lifestyle, earlier there was focus on value for money. Now there is focus on brand perception. People are ready to pay for convenience. If you recall Zomato, earlier they used to give discounts, free delivery. Now discounts have got reduced. They are started with 2 rupees platform fees. Now they're charging 15-20 rupees platform fees. So that means people are more willing to pay for convenience rather than looking for discounts. So I think that is the thing that is a change in lifestyle. So you see the kind of wealth creation which has happened in Zomato. Blinkit, the kind of growth, 100% CAGR that company is growing with improvement in margins. So that is happening. Same thing, you can say eating out, packaged foods, F&B. I think all these are things we are seeing in our normal course of time. And in spite of slowdown, these kind of companies, these kind of sectors have created huge wealth for the investors. And if the actual turnaround comes in, so we believe that these kind of segments can grow even faster. This is a slide I was mentioning, above 30 lakh households. Currently we have around 84 lakh households which are earning more than 30 lakhs annually, which will be 3x in next 5 years. Between 10 lakh to 30 lakh, we have around 9 crore household, which will be 17 crore households. So basically you can see the kind of wealth getting generated, but we have to focus only on the top 30-40% of the households, which will drive the consumption. Formalization, we all know. So I'll just give one example. There are 4,000 cities in India. Metro is present only in 200 cities. So that means 90% of the India is still underserved by retail chains. So I think that gives formalization and technology adoption, these things. So we'll be making this portfolio based on these qualitative factors uplift, and quantitative will try to ensure that whatever companies will buy, they are growing more than the nominal GDP growth of 12-15% CAGR. At the same time, ROE, ROCs are more than 25% of those companies, and operating margin should be stable or improving. So I think these are the quantitative factors we'll look to buy. And as long as companies are growing in mid to high teens, I think over a long-term period, that is the potential for the investors to generate that kind of wealth over the long term. So I'll stop here. Maybe we can have time for Q&A or anything on market or funds. Yeah, thank you.
Thank you, Mr. Dikshit. That was quite informative. I would invite Mr. Kandaswamy. Kandaswamy, you want to ask a question? You want to answer?
Yeah, sure.
Yeah.
Which one? Tariffs. So tariffs, if you see, direct impact is very, very minimal because exports, as I showed in my slide, that is only 2 to 3% of our GDP, right? But there can be indirect impact because if something happens to the textile sector, to the leather sector, I think these are large labor-intensive sectors, and there can be some indirect impact on the GDP. So I think that is the reason government has tried to blunt this impact by giving this stimulus of GST cuts and all these interest rate cuts. I think they are trying to manage. But we are hopeful that this tariff thing will be thing of the past by the end of this year. If that happens, I think market can go into next orbit. But if these things sustain, I think 30 to 50 bips is the negative impact on the GDP of this tariff, and which the government is trying to negate through these things. Sorry? Gross profit, I have to check, I can't recall as of now. If you see corporate profits to GDP is around 5%. So GDP is now $4 trillion. So you can calculate 5% of that. So 4 trillion means so it's really similar kind of. Yes. Yes. So, but in a positive sense, you can say tariff-related sectors have very, very low representation in the index. So that may not impact the market, but economy can have some. Last 1 year, we have been growing at 7-8% CAGR. So if you see my PE chart, so last 1 year index return is 0, but our P multiple has come down by 10%. So that means at this point looks unlikely. We are expecting at least 17 to 18% growth next year. There are reasons for that, because this year growth has been subdued because if you break down the index, largest segment of the index is BFSI, banking, which has faced the margin pressure because RBI cut interest rates quite aggressively, and many banks have external benchmarking loans, right? So if you see, your home loans have come down by 100 to 150 bips in last 1 year, right? But banks FDs, which is their cost of funds, they come down gradually as the FDs mature, as the new rates get passed on. So I think that is getting over by Q2 of this year. I think this is the worst quarter for banking. And as the margins normalize, credit growth is quite healthy in the market. So 40% of the market, which is BFSI, is growing in double digit next year. Consumption, as I mentioned, has the potential to revive big time next year. Then you can say one of the large weightage in the index, which is Reliance Industries. Their Geo, you can say telecom arm as well as the retail arm has been growing at 15-20% CAGR. So that is also on an aggregate basis growing in double digits. So 70-80% of the index has the good earning visibility going into next year. So only commodity related stocks have less, but I think going forward, 15 to 20% earning growth seems quite good. Sorry? Yes. So, no, basically what is happening is there is a global bull market in the AI related stocks. So, unfortunately or fortunately, we don't have much play in India. So, maybe people are investing into US, China, Taiwan, where these stocks are listed. But the kind of valuations we are seeing in AI, so if that trade reverses, I think India is likely to be the beneficiary. But anyways, there is a silver line because of this emerging market rally. Now emerging markets have been outperforming the US market. So the kind of outflows these EMs have seen, if that reverses, India will get some portion of that. Even though India may remain underweight, but still India has close to 20% weight. Even if they put 10-15% of incremental money in India, so that has the potential to revive the overall investments. It's around 19 to 20%.
Thank you, Mr. Dikshit. Please be on the stage.